Another day and another rules change that benefits the banksters. So the Federal Reserve Bank just announced a new round of phony stress tests that the large US banks supposedly passed and immediately loosened the rules on share buybacks. And immediately following that, JP Morgan Chase Bank just announced a new $30 billion share buyback plan. But where did those $30 billion come from? Especially with the velocity of money, the large banks are supposedly not lending into the real economy here in the US. But the truth is the banks don't need to make loans into the real economy to make tens of billions per year in profits anymore. Over the last couple decades, this has changed a lot. I've had extensive conversations with former managing director of Goldman Sachs and Bear Stearns, Nomi Prins. I highly recommend checking out her books and looking at her interviews. And while I don't agree with all of her opinions and especially her politics, she does have unique insights into how things work at a large bank, especially at the top for senior management level decision making and how they allocate capital and make investments. The way things have changed at the large banks and how they make profits is the banks have focused over the last couple decades on divorcing themselves from the real economy so that they have a lot of their profits insulated and protected. Luke Groman recently did an interview in the last couple months on the Investors podcast with Preston Syke, and he talked about how the large bank profits really only dropped for a couple quarters in 2020, and we're almost back to 100% normal, especially for some of the larger banks like JP Morgan Chase. Well, how did that happen? Because the large banks have focused on diversifying themselves, moving away from making loans into the real economy because there's too much rules, regulations, red tape, and the profit margins for the banks making a lot of boring vanilla loans are very, very low. So the banks focused instead, rather than making a lot of loans into the real economy, and this is why a lot of my podcast listeners who are small business owners, and I have a lot of them, can't get small business loans. And it's been this way since before the pandemic, but it's just gotten worse because the large banks don't need the real economy anymore to make tens of billions per year in profits. How do they do it then? They do it by selling bonds, selling these credit instruments and derivatives, toxic sausage, to pension funds, to bond funds, bond portfolio managers all over the globe. And then they take these reserves that the Federal Reserve Bank replenishes, just like in the game of Monopoly. If they go and blow the reserves, and the reserves are used as collateral, like casino chips. So imagine if you go to a Las Vegas or Macau casino and you're a VIP roller, and they know you're going to spend a lot of money, so they comp you some chips. But imagine if you blow through the chips and they just comp you more casino chips. And that's how things are with the banks and reserves. So if the banks blow through reserves, they just get more. It's just refilled for them automatically. And the banks use reserves, and I've had conversations about this with Nomi Prins at length, both in person and over emails over the years. And she worked for many years as a managing director at Bear Stearns and Goldman Sachs, and she's talked about how things have changed with how the banks have decided to make profits. They wanted to insulate themselves from the real economy. The banks love to make enormous trades and gambles and market manipulations, speculating with leverage trades, and then they leverage up the trades even more, borrowing in the Eurodollar market and also from the repo market, gambling on currency trades, leverage currency trades, gambling on leverage bond trades, and gambling on over-the-counter derivative trades. And that's how the banks have so much capital. But the bank stocks have actually underperformed the stock market rally, the phony stock market rally that the Federal Reserve and other central banks have helped engineer since March and April. So we have the Dow around 30,000. I haven't checked it today. But the XLF, as you can see there on your screen, which is the Financial Select Spider, the financial ETF, which has a mix of large banks and insurance companies in there, it is down still around 7% from its February highs. And so the banks are looking at this and saying, well, we've underperformed general stock market, and a lot of investors are worried about the bank's exposure to the real economy and commercial real estate. But as I've explained now for a long time, The banks, while they do have commercial real estate exposure, the Fed and the regulators and Congress here in the US will just keep changing the rules so the banks don't all go bankrupt. There's just so many rules changes, and as long as the US has the world's reserve currency, they can get away with this. And the Fed's balance sheet is starting to drastically expand again. It's over 7.3 trillion, but the banks have figured out over the last couple decades how to make tens of billions of profits without massively increasing their loans into the real economy. So they do this through derivatives, bond trading, leverage bond trades, and they do this through leverage currency trades. So the more currencies move in exchange rate, the more the banks can make on their leverage trades. And then the banks have also used the yen carry trade as a funding trade for a long time now too, just like hedge funds. At this point, the banks basically are hedge funds. They're government protected hedge funds. It's basically a front with the large bank and all the branches because the real business isn't making loans. The bank's real business is taking that depositor money and using it as collateral and leveraging that up and going and gambling in the casino on currencies, bonds, and derivatives. And then also manipulating markets and then selling bonds, this bond scheme that Wall Street loves, because a couple years from now, they don't care if the bonds blow up. As long as they sell these corporate bonds and these credit instruments and this debt, that's all that the bond salespeople on Wall Street and that the senior banksters care about. So the goal is to move the bank share prices back up with the share buybacks. And of course, the Fed, which is owned by the large Wall Street banks, the Fed is more than willing to accommodate the rules changes and the goalposts moving. Welcome to dystopia, where if you are a senior bankster, you can manipulate markets, you can get the rules changed, you own both political parties in Congress. I've spoken to bank lobbyists here in DC off the record over the years, and they do own both political parties. So the banks have figured out how to win no matter what, at least for now, until the dollar loses world reserve currency. Please consider becoming a patron over on my Patreon and chipping in $5 or more per month. So that way I can continue to do my research and make unique content and be able to make a living. Because with my YouTube channel, my Google AdWords revenues have collapsed almost to zero. My YouTube channel subscribers have stopped growing in the last 9 months. There's no growth there. And my live stream shows have been shut down, and YouTube tech support is giving me all types of excuses, claiming that they did not put a strike on my account, even though I can't edit the title for a live stream show. I cannot turn monetization back on. I cannot even turn live chat back on. That's how bad things are with the live stream show. I have almost 150, and hopefully soon it will be over 150 unique pieces of content behind the paywall on Patreon in terms of well-researched articles. Some of the articles have taken me many, many hours to produce for lots of different topics about gold miners, silver miners, precious metal royalty and streaming companies, a lot of articles about the oil industry and other commodity industries, also global macro related articles. There's also audio podcasts on a lot of stock charts and technical analysis there too. And while you are getting unique content, if I go over 1,200 patrons and I stay there, I will sign up for another live streaming service just for patrons. So I will make this pledge, I will make this promise. If I go over 1,200 patrons and I stay there, so if I drop below 1,200 patrons, the promise is not going to stay. I have to stay at 1,200 patrons and stay there. I will start to do live stream shows just for patrons behind the paywall there. Will require additional capital. I will have to sign up. I think it's $100 a month for another service there to integrate with Patreon, to sign up there and integrate. So that will be an additional added bonus for patrons if you want to take me up on that. But please chip in if you can, as YouTube is basically trying to make this impossible for me to grow my channel or to make a living from making content.